Hi, everyone. Welcome to this ISG Smart Talk. Today, our software advisory team will discuss looking beyond discounts when sourcing IaaS and PaaS. Before I hand things over to our presenters, I'll quickly run through just a few items with you. We are recording this webinar, and you can access the replay using the same link you used to register. So please feel free to forward that link to anyone who may be missing today's session. You can submit a question at any time during the presentation by using the Ask a Question box on the left side of your window. That about covers it on my end. So with that, I will hand things off to Bill Huber to kick off today's Smart Talk.
Thank you, Jillian. And thank you all for joining us today. So very quickly, I'm going to go through the agenda, give you a very quick short commercial about ISG, introduce the panelists, and then turn over to our subject matter experts. So we really want to tell you a little bit today about what is the infrastructure as a service, the platform as a service marketplace evolving into right now. How is it changing? How does it affect you? What are the value definitions that apply to it? How should you size up when you contract for it? And then basically, how do you manage it going forward? Because as you'll see, as a service is simply going to take a larger and larger slice out of your total spend. And a lot of our clients are really struggling with, how do I optimize this? It's a growing cost. I know it's important. How do I do a business case for this? How do I understand it? How do I manage it and keep it from getting out of control? So very quickly, our presenters today are Louis Pellegrino. Louis is a director in the software advisory practice. He's been with ISG for about 8 years now and runs our Microsoft Center of Excellence globally for ISG. Kevin Davis is the newest member of our team. He is a principal consultant based in the Atlanta area and has already added quite a bit of value to our clients, focusing on cloud procurement. Very quickly about ISG, most of you are probably familiar with us, but we are the largest IT-focused sourcing advisory and research firm globally. We have about 1,300 professionals located in the US, in Europe, in the Asia-Pacific region, and in Canada. We have sourced over our history nearly $500 billion in technology sourcing deals, and that has given us a tremendous amount of real-world experience, data, and most of us are practitioners like yourselves. So what we hope will come across when we present to you today is that we've all had to live with this kind of advice, and we hope what you get here will be very practical and something which you can readily apply to your business this year. The software advisory practice is a growing practice within ISG. We focus on large software transactions, cloud transactions, software asset management, technology upgrades, and all things cloud. So with that, I'm going to turn over to to Kevin to introduce you to the marketplace. Kevin, over to you.
Thanks, Bill. And thanks everyone for joining today. I think we're all aware of the large public cloud providers that are out there, the Microsoft, the Google, AWS. The spend here obviously is increasing year by year. You can see the growth on the right side, and that's contracted values that continue to grow at a huge rate. And the reason for this is these cloud providers are pushing large committed deals. And if enterprises are not well prepared to drill into these deals and match a commitment to the consumption, then there's definitely a large potential for overspending. And the providers will definitely show you how the growth is increasing this much and convince you to commit to these larger commitments. But the thing to remember is matching your consumption and demand to what you're willing to commit to. And here's the pie chart of worldwide public cloud sales. You see the leaders on the right. Everyone's familiar with it. But the main thing to point out here is there's a huge chunk of spend and niche providers and specialty cloud providers that are still out there in the market. So the Amazons and the Microsoft and Salesforce are continuing to claw up those pieces of pie, but there still is a big chunk of other providers out there that offer a lot of the same services that you could get through the main three. And here's more of a look of the public IaaS market. Obviously dominated by AWS, Azure, and Google. They consume 70% of the market share. It's ever expanding, obviously, with COVID playing a part and enterprises moving more towards needing more cloud services. So they continue to gobble up this market and this bucket of spend. But like I said, there are opportunities out there with other vendors outside of these providers. And as you would expect here in the leader quadrant, it's AWS, it's Microsoft and Google, followed up by some of the other ones you're familiar with. That's why they continue to lead the charge. It's who most people go to. And it provides the confidence and the ability of these guys to sell these large committed deals because they are seen as the leaders. But like I mentioned, there are other opportunities out there, and I'm going to pass this on to Lewis, and he'll talk to you more about looking at your committed deals and providing some strategy to make sure it is right-sized. So Lewis, over to you.
Thank you, Kevin. Thank you, Bill. Good day, everybody. My name is Louis Pellegrino, and I'm going to carry on the conversation that's been kicked off by my colleagues. And what we really want to do is kind of help reshape the orientation that we are helping our customers sort of process when they're talking to the large hyperscale providers, especially now as the market has begun to mature and really kind of grow at a significant rate. As Kevin has already mentioned, the emphasis now from all the big providers is to really drive commitment through multi-year deals. And while they have become a little bit more creative in how they establish that commitment is still critical to the ability for them to sort of invest in their platform and to kind of make the forecast that they go forward with. And their zeal to get your business is that they can produce all types of models that show consumption trajectory and forecast and make it look like it's very simple, to go from $0 to $10 million in just a few short years. But that needs to be tested. And simply put, most of our customers who ask us to help them as this conversation with their providers is unfolding is, how do I really align what's being offered with what can be consumed? And the simple truth is that for most customers who are starting this journey, and of course that's a minority of the group. A lot of people have already begun their journey and are in various stages of deployment. But it is very difficult at the onset for people to predict with any certainty exactly what type of services they're going to deploy, in what quantity, and the velocity of magnitude. So this is an exercise that requires time. You need to monitor it. You need to validate it in order for that data to be used back on the input side so that you can continue to refine exactly where your spend is going to. The caveat for most customers with these large transactions sitting in front of them is you're put into a position what we call take or pay. And that is either you use what's been offered or you wind up paying for it even if you don't use it. So this is something we really want to try to avoid. And as this market has really evolved, and I've been involved with this, I use the crawl, walk, run metaphor a number of times. And I remember when, getting just $1,000 a month of commitment was a big deal as these providers were kind of kicking off. And now we've certainly moved through that stage. We've moved through the walk stage. We're clearly in a run stage now where it is very common to see proposals landing on large customers' desks for anywhere from $20 to $30 million a year. And so this is now the challenge for most customers is where do I find value in that 30 million or whatever the size of the deal is? And so, what we're going to talk about here is the tension that's inside of the business models today, as discounted meter rates have always been sort of the standard way to drive additional value. But increasingly, the large hyperscale providers are looking for ways to not necessarily document meter rate discounts. And so what we have to do is figure out how do we generate additional value for every dollar of spend you give to provider. How can we create a value proposition on top of that, getting $1 and something's worth of value for that spend? This graphic is intended to sort of give at least an illustration of what we're talking about. All right, so on the graph here, we have basically three axes. we have the green horizontal bar, which in this case here represents a commitment of you to your provider. So this is a 5-year deal. It's initialized as $15 million, which of course is a $3 million a year run rate. But what we want to do is we want to be able to create an environment where that commitment opens up some space, a space that we kind of call the value equivalency, where I have access up to $18 million worth of value for my $15 million spend. And then, of course, we've got the actual work of getting there. Starting typically, most organizations are not prepared to consume the full run rate on year one or day one, but they will work their way up to that point and eventually break through the commitment that they've laid, hopefully break through the value equivalency that's been available to them. And in this particular example, what it's showing is that we've got a gap of $3 million between what is the committed spend and what's the value equivalency. This customer was able to tap into basically half of that. If you did the math here, the consumption trajectory would be about $16.5 million. What would have made this even more lucrative would be for that same client to have increased their velocity to deploy sooner and in more quantity so they could tap into the full value of that. And again, the last point to be made here is that with a lot of this type of purchasing kind of being sort of a purchase for which end users are going out and seeking advisors like us, the providers are becoming a little bit more guarded with creating artifacts, licensing or pricing documents that really sort of detail in any specific way discounts that have been given to those customers. And in fact, now we're looking at another way to sort of create value beyond just a simple discount. There will still be deals where discounting is important and still have availability to it. But the challenge is those deal sizes are getting bigger and bigger and bigger by the day. So what we're trying to do and what we have seen is where discounting is not as available or is not as interesting in terms of what percentages people are expecting, we should be looking for different outcomes that can drive value in a different way. We kind of look at this across 3 different axes. Volume, how much of a particular service are you consuming? Total value, what's the absolute value month over month that you're giving to this provider? And lastly, velocity or rate of growth. How quickly, month over month, are you increasing your consumption for a particular set of services? And with that, we are helping clients to kind of come up with a model that helps them generate what we call earned credits. So that what happens with your commitment, with the actual monies that you've agreed to pay the provider, there is a contribution that your same provider will pay back to you that can go onto account to help fund future consumption of these same services. So we come up with these 3 different axes, volume, value, and growth, and work with end user organizations to define the metrics behind how those can actually be leveraged in order to create this concept of earned credit, which is basically your provider paying you back for a certain performance that you're giving them in order to sort of fill that gap between the first, in the case here, the $15 million committed spend and the availability of up to $18 million worth of value from the service provider itself. So if I take this and I just look at it in a different light, I have a graphic here which sort of says that in the center of that circle, that concentric circle, we have an amount of money that is specifically being funded by you. Now, the concept of commitment is evolving. At one time, the commitment really was a prepay. You set aside a sum of money, and that sum of money financed your consumption of services over a fixed period of time. The providers have become a little bit more flexible here. So if you don't want to tie up that money on day one and have it all front-end loaded, there's a concept called commit to consume, which basically you're making a forecast to whoever your provider is that you will spend a sum of money equal to X over a fixed period of time. And if you do it well, that means you will actually run through that contract term, you will get to the end of the term, and you will have consumed everything that you had forecasted you would consume. But in the event that you did not, in the event that you fell short, you still are obligated to pay whatever the unused balance of that commitment was. So it's just a matter of where does that risk expose itself? Does it expose itself at the front end of the transaction or at the back end of the transaction? But in any case, there's a portion of it that you are responsible for, and we're going to call that the client-funded commitment. And what we want to be able to do is through a series of exercises, is really become very familiar, or at least very confident in what your landing zone is going to look like. The landing zone being the set of services that need to be provisioned for you by your provider to accommodate your compute, your network, your all of the various categories of service that will support the workloads that either you're migrating to that provider or that maybe you're building from the ground up. And we want to have that landing zone sort of understood, because this is where the concept of an earned credit really sort of begins to play into that, because you want to make sure that whatever your committed amount is, that if you sum your earned credits with it, you still have the ability to consume everything that's the total of what you're willing to pay out of pocket and what your provider will supplement your payment with. And there's really no need to sort of over-engineer this. I mean, we think of three different triggers. We think of the volume trigger, we think of the absolute spend trigger, and we think of the rate of growth trigger. And what you can do is you can decide to settle on one, two, or all three. But we, in any case, we really kind of advise not to over-engineer this, because it becomes more difficult for your provider to basically operationalize it. And it's something that can't be monitored and measured is really not going to work. And again, why we're going down this path is that we're seeing for many customers who are not yet large enough or have not made enough of a migration to warrant a $10 million a year run rate, the discounts are becoming less and less attractive. And so you need to sort of look at this sort of through a different lens to figure out, how do I get more value out of that same spend? So when we think through this, what we want to make sure is that any customer who's with, whatever your hyperscaler is, if you're spending on average $3 million a year or more, but you're not yet up at that Uber level, where you're at 10, 20, $30 million a year in terms of commitment, but you're still you're a healthy customer, but a customer where not as recently as 2 or 3 years ago, you might have been able to negotiate some decent meter discounts, but that's becoming harder and harder to do. So you should have a plan that allows you to work with your provider to test on a monthly basis for certain performance outcomes, whether that you've agreed that you're going to use so many instances of a virtual machine template, whether you're going to have a certain dollar threshold that you commit to, and if you overcommit, or if you actually deliver more consumption than that commitment is, that there would be some sort of recognition and credit return to that. Or if the rate of your growth, if you agree that 10% month over month growth is sort of standard, but you're able to generate 20% month over month, that there be some sort of earned credit that results from that. And again, when we model this out, we want to sort of begin with the end in mind and sort of figure out what is our potential to earn additional credits. And then once we know what that subtotal is, we want to make sure that the amount that we commit to when summed with that earned credit is really digestible. Because if you have the commitment up front and then you deal with the earned credits as a supplement to that, you may be, creating a situation where you can't fully exploit all of the value because you've established that committed amount just a little bit too high, that by the time you sum your earned credit with it, you've created a volume of consumption that may not necessarily be achievable for you. So this is really kind of, thinking through that process before actually having the conversation with your provider, and though that you can sort of land a reasonable commitment that when summed with the earned credit potential leaves you with a total amount that you are able to actually consume and perform on. So if we look at this, what I want to do is quickly transition into a sort of a model that would look at this in the light that I just said. How do I sort of reverse engineer and size a commitment that will be within my means to actually deploy and consume? So staying with the same theme of the $15 million a year customer over a 5-year term, I've got a table here which represents that horizon, that planning horizon. I've got the 5 years, and I've also got kind of a ramp of consumption that from year 1 to year 5 would represent the total consumption necessary to eat up $15 million. So that's going to be one data point. The second data point is targeting how much value that committed spend should actually leverage, whether it be infrastructure services or platform services, extrapolating what the value equivalency is, and then determining whether or not, based on that exercise, the final resulting monthly run rate, is that a number that you can actually use? And as such, begin to plan the process correctly. So again, I'm going to start here and highlight the fact that this is a 5-year plan. We've got growth. We have a deployment trajectory of 15, 15, 20, 25, and 25, which collectively gives us 100% of our consumption. And if we look at that in terms of the $15 million spend, that means I've got this trajectory in my model that gets me to $15 million of total spend. What I want to be able to do now is sort of think through that and figure out what's the value, what should that annual spend actually leverage in terms of value. And, you know, we have this sort of trajectory where this would look like to the provider itself, even though it's not a discount per se, it would be processed internally as sort of a 16% discount, because what they would be doing is giving you headroom up to the value equivalency threshold. But your commitment to them is simply what you have already instantiated as the $15 million. So how do we fill that gap? How that gap gets filled is through the concept of the earned credits. And what you do and how you do it allows you to tap into that space. It's actually a 20% increase in total available services, but looking at it from the provider perspective, it's about a 16% discount. So we've got kind of through this model here, we've got a consumption rate of around $98,000 a month for the infrastructure services. And this is based on an allocation. Normally, when a customer is using services from their provider, they're using compute services, they're using storage services, they're using database and analytics and management and machine learning. So we kind of compartmentalize the total spend across these different categories. Infrastructure certainly, and compute is certainly one of the important ones. But in this exercise, we've kind of weighted our distribution of our commitment to infrastructure at 30%. Similarly, when we look at the balance, we've kind of taken the rest of the stack, all the other things that would be more of the platform-centric activities and services, and we've weighted that at 60% of the total deal value. So that by the time you get to the sort of final analysis, you've got these two different inputs. You've got an infrastructure spend and a platform spend that collectively, depending on where you are in your term, are anywhere from $225,000 to $375,000 per month. That would be the amount of spend that you would have to be able to consume. All right, so what would you need to provision in order to generate that type of spend? All right, so it's a multi-step process. So first we're figuring out how much spend leverage do we have. All right, and in this part of the exercise, we can see that over a 5-year term, the spend leverage is anywhere from $225,000 per month at the onset of the term up to $375,000 by the time you get into years 4 and 5. So now, what is it that you would have to do and actually to consume that? So as I mentioned, we looked at the total spend, and we then begin to sort of develop an allocation of that spend. In this analysis, or this particular example, the categories of spend that we have include compute, database, the analytics, storage, artificial intelligence and machine learning, and some element of management. And you can see that we've kind of weighted the distribution as shown over here in the left-hand column. Now we've got sort of a carve out of how much we really have available to spend in that category. And what we typically do now is we work through the provider's portal itself. All the providers have a sizing and estimator portal where you can do some simulations. And for this exercise, in order to kind of keep it real simple, in all cases, whether it's compute or database or storage, we wound up, for purposes of the example, selecting the largest template or the most significant configuration that they had available to actually provision. So what this means is, because at the unit cost, these are the most expensive units that they have available. When we divide them into the amount of money we have to fund them, we're going to wind up getting a low unit total. So if I take the compute line item, for instance, you can see that based on the allocated spend of 30%, I was able to generate units anywhere from 67 to 96 VMs for that particular category. Now, in all honesty, nobody would make all of their VM templates at the size that we have here. Some of these templates here are like 48 core machines. Most customers are going to be creating compute scenarios with 4, 8, 16 core machines. There will always be a limited number that will be much higher. But the net result is if you're going to use smaller templates or lesser configurations, these numbers are going to increase in proportion to the size of your template. So while these numbers may look low here, by the time you really do the math with the templates and configurations that you intend to use, they're going to increase substantially. Likewise, the same logic holds true for the databases. In all of these examples, we've picked a very large template or configuration to do our math in. And the reason behind this is if you saw these values at this level, and these values looked greater than what you thought you had the potential to deploy, what that signals is maybe that the commitment is too much, all right? And that you need to sort of step back and maybe resize your commitment to something less than that and repeat the exercise until you get to a place where the resulting numbers of either compute databases, AI machines, storage racks, those numbers look more realistic for what you're able to actually deploy and consume over the term. So taking this and putting this into sort of a more of an editorialized bottom line, here's the reality. In all of the transactions that we support where we're helping a customer process what has been either an unsolicited offer for large multi-year deals, when we look at what the value of the offer is and we kind of take it back to the steps that we just did, we can almost certainly guarantee that the offer is overstated in terms of your ability to consume that. The approach behind discounting is really now reserved for those customers who are approaching the $1 million a month threshold. It doesn't mean discounting is not available on other lesser deals, but you're not going to be able to generate double-digit discounts, the same way you were even as recently as 2 to 3 years ago at scales less than the $1 million a month threshold. So if you're counting on discounts as your only strategy to try to drive value, you may be missing the opportunity because you're not at one of those mega consumption levels or mega commitment levels. So you really do need to think through, alternative ways to generate and recognize value. And, this concept here of looking at your performance and measuring your performance across multiple axes, and whether it be a volume axis, a total spend axis, or kind of a velocity of growth, those become kind of the extra sort of tools in your toolkit to work with your provider to extract incremental value in order to create that buffer or that value equivalency zone that we're talking about between what you're actually giving your provider and what value they're allowing you to tap into. You want to do this exercise thoughtfully, because if you're asking your provider to generate earned credits, which basically go back into your funding mechanism, they're no good if you can't use them. So you really want to make sure that whatever you're envisioning as sort of the supplement that's coming from your provider, that when summed with your commitment, still puts you at a number where you comfortably have access to the consumption necessary to tap into all that value. And you really do need to think about this, with several months of lead time. This is not something that can be done in a 45 to 60-day cycle. And we see a lot of customers, getting these transactions, these offers that have, very short fuses. This deal is good for 30 days. This deal is good for 60 days. That's all fine and well. And if you have the data to support that you have the ability to consume that, that's fine. But most clients don't. Most clients are weary and are somewhat sort of skeptical that their ability to consume to the volume of the offer, is not necessarily a certainty. And so these are the exercises that we embark upon with our customers to make sure that there is better alignment between what they can forecast and what the hyperscaler is actually proposing in terms of total deal. So with that, I'm actually done with my piece of the discussion. I'm going to turn it back over to Bill to maybe open up the floor for questions.
Thank you, Louis. And Jillian, would you like to give us our first question, please?
You bet. Just a reminder for everyone, there's an Ask a Question box on the left side of your screen. That is where you can submit questions to our presenters. We'll get to as many as we can today, and if we don't get to yours, we will follow up after the webinar. First question we have, if we're looking for our best pricing option, is it better to work with a pure play hyperscaler or someone like MS who has other business interests? Kevin, do you want to start us off there?
Sure. Thanks, Jillian. Great question. Obviously, it's always good to play these vendors against each other. But when working with a vendor who you already have interest with in other products, like Microsoft, most everyone has Office 365. You have an EA coming up every 3 years. It's always good to leverage that additional spend you have with a vendor when negotiating these cloud services agreements. So, good question. What else do we have, Julian?
All right, next question. Is prepay the only way to secure price discounts?
No. Discounts depend on a lot of variables. Annual commit, total commit levels can affect, obviously, the discount. But we discussed how you can earn some credits and other means to generate more leverage for your cloud spend. Just encourage you not to focus just on discounts. It is your commit versus your demand is what's most important, like Lewis discussed.
All right, thanks for that.
Mm-hmm.
Yeah, Jillian, if I could, I would just like to add one more thought on to
Sure.
Kevin's. Discounts are really an effective sales strategy because they can distract you from the core conversation, because buyers tend to lock into thinking about discounts out of the gate. So we would always just recommend discounts are critical. Make sure you understand them, but do not get into the discounts until you've really nailed down all the other parameters of your discussion, because only then are the discounts going to be something that are meaningful in the broader context of the volumes and the other commits that you're making.
All right, thanks, Bill. And our next question is, over 5 years, through the learning curve and introduction of FinOps, consumption will not be a linear increase, but should become flat for certain areas after 2 to 3 years. How will the earn back mechanism cope?
Let me. So there is some reality to the fact that at some point your migration to the cloud will have a period of time when it begins to flatten out, and that could be through a combination of retirement of applications, refactoring of applications, and certain other variables. So the earned credit concept obviously will have to evolve with your usage profile changes as well. What we're talking about here in the near term is largely sort of a tool for customers who are kind of beginning that transition or are in the early stages of that transition, where the line of sight to when they go flat isn't yet clear, because a lot of them are just doing the lift and shift right now because they just want to get out of their data center. They're deferring some of that refactoring or retiring, until they got the first wave of activity done. Now it remains to be seen with the second wave, are they actually going to execute on some of those efficiencies and refinements that they had predicted to be leveraged in order to flatten that out? So I don't know that the earned credit option can sustain in perpetuity, but for many customers, that flat line that they think they're going to arrive at is not, it doesn't just happen. You still have got work to do. The lift and shift was phase one. The refactoring and refinement is a subsequent phase, and you really need to kind of complete that, and then to look for new opportunities after the fact to extract incremental value from your provider.
Thank you, Lewis. And our next question is, do earned credits continue to accumulate after the commitment threshold is reached?
Well, the concept of an earned credit, as we apply it, is it lives within the term of the agreement. So whether you're on a 3-year term or a 5-year term or whatever other negotiated term length, our test would apply to monthly triggers. And those monthly triggers, either you pass through them and you get a supplement added to your future spend or not. I don't know that they would, I don't think that any provider would allow an unused credit to be carried forward into a new term. So it's up to you to figure out. This is why the sizing exercise is so critically important, because we want to make sure that we establish the pay commitment, that part of the spend which is coming from us directly, that summed with whatever we're targeting for the earned credit leaves us in a place where we don't leave anything behind. all right? Because you don't, it seems crazy to create this opportunity to earn a credit, but not be able to actually consume it because you overcommitted on your baseline number.
Right. Okay. Thank you again. Next question we have, do you see hybrid private data center providers going into partnerships with public cloud providers such as Azure, AWS, to bring value as they are increasingly seeing the public cloud providers expand into their core offering? Who wants to take that one?
Bill, that looks like more in your wheelhouse, Bill.
Yes, thanks, Louis. So we see a huge mix. It's very much an ecosystem, and if you look at the major service providers, your classic outsourcers and things like that, many of their solutions are being built on the hyperscaler platforms, and many of the systems integration solutions are being built on the hyperscaler platforms, and many of your critical apps that are moving to the cloud are doing it in conjunction with the hyperscaler platform. So think about even SAP or Oracle or anything else. So it's very much a complex market, and one of the things that we tell our clients to really do or consider when they're entering into a deal is to make sure they can deconstruct the various elements. Because yes, you might be getting a terrific synergy by a bundled solution being packaged by an SI or by a service provider, but make sure you understand the components of it, make sure what your overall termination rights are, your commitment rights, how you can apply credits from one thing to another, what happens to the deal if your satisfaction with the SI or the service provider wanes over the course of the deal term. So it's good to understand that stuff. There's a lot of value being put forward by those solutions, but it just means there's a lot more complexity on the buyer to really dissecting the elements of that deal and making sure that the deal will provide value not just now, but if things take a different turn a year or two from now, either higher growth rates, lower growth rates, service problems, whatever it might be. And I'm happy to follow up and address that in greater detail.
Thank you, Bill. Next up, could you please explain the importance of cloud governance before starting with big scale projects, consumption versus real usage, please?
This is one of the things that has now become most acute in sort of the look back scenarios that we're working with some of our clients who have already undergone a commitment deal of one sort or another. And that the ability for people to sort of create service obligations or to spin up services sort of out of band with some of the stated directions and intentions. Most customers who enter into these multi-year committed deals are of the belief that that's the total spend, that they're really not going to expose themselves to any overages or incremental spend over and above what they've already committed to. However, some of them are finding out just the opposite, that even though they've made a substantial commitment, some of the leakage that occurs because there isn't a governance model in place is creating some unwanted side effects in terms of creating overages that they had not otherwise intended or expected to be subject to. So we're working with a couple of clients right now who have already gone through this to create a governance model that puts a little bit more control around how and when services are actually qualified for a spin-up, how they're managed after that, and ultimately how they are retired so that they're not left behind as an artifact that has no real leverage in terms of the business. But I think this is a great question. No matter how good the deal seems in terms of the box that it's presented in, your governance or lack thereof will have a great impact on whether or not you're able to achieve your business outcome within that budget, or if you wind up exposing yourself to overages.
All right. Next question. Do not all major cloud providers also offer pay-as-you-go depending on the volume you use?
They do, but this kind of comes back to you can get pay-as-you-go, or you can get a much better deal by committing to a certain volume for which we'll give you these various discount rates. And so the pay-as-you-go model is often used to to try before you make a significant commit, but almost in all cases, they're going to try to move you to a committed volume and offer incentives of discounts and other credits to get you to do that. Louis, anything you'd add?
No, the pay-as-you-go is, and in fact, part of the market is under contract. Another part of the market is sort of people who just do the portal-based interactions, with whoever their providers are. And so, of course, those are the people whose consumption is largely pay-as-you-go. But when you're in the threshold of the $1 million a month client profile, that's no longer a pay-as-you-go profile, because for all the reasons that we just said, pay-as-you-go, this whole concept of an earned credit doesn't exist. So if you're going to be spending that much money with a provider, you want to engineer all of these value add extensions to your framework for doing business as possible. Some of it's going to be discount, which would actually be a reduction in terms of the meter speeds, but increasingly, they're getting stingier and stingier with how much they're willing to yield on meter discounts. So what we have to do is, create another means to sort of add value to the deal, and that's the concept of earned credits.
Okay, a couple more questions to get through. Can you get value through other means such as migration services funding? Kevin, do you want to start us off?
Yeah, sure. Yes, but I mean, there's a bunch of questions to ask around that. Funding for what? Like Louis mentioned, you need to ask a lot of questions about what their funding is for and how it's going to be measured. We've seen before where they base it on one of their $500 an hour rate cards, and all of a sudden you burn through this funding very quickly and did not get that value. So it's important to try to understand how much the migration cost is still your responsibility, since it's unlikely the provider will fully fund what you're trying to do. So make sure you ask the right questions to understand everything about their funding, what it goes to, and how they measure it.
All right, next question. I've heard reserved instances are already priced at the floor. Can you get further concessions if you make a large enough commitment?
I'll take this one. Yeah, I mean, reserved instances, they're already very well discounted. So expecting to see any kind of double-digit discounts are highly unlikely. So if you're looking for additional concessions, it's going to come in other area buckets like database, networks, analytics. And mostly, like Louis mentioned, is going to be in those additional credits. If you're looking to cut costs and looking for discounts, let's not focus on discounts. Let's focus on those earned credits that you receive in return for your committed spend.
All right, it does look like that was our last question, so we'll go ahead and wrap things up. We do appreciate you joining this ISG Smart Talk. As mentioned, you can find the recording of this webinar at the same link you used to register for the event. And if you have any further questions or would just like to get in touch, you can find us at www.isg-one.com. Thanks for joining.